I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings, and I'm joined today by Narayana Kocherlakota of the University of Rochester, who has done a paper for the Brookings Papers on economic activity about what was happening at the Federal Reserve while he was the president of the Minneapolis Fed, a job he held from October 2009 until the end of 2015. So, Professor Kocherlakota, let's start with the basics. Your paper basically has 2 points. One is that as a theoretical discussion of why you think it's a bad idea for the Federal Reserve to stick to some well-enunciated rule. You'd rather give policymakers discretion. And secondly, a discussion of why you think the Fed was essentially too stingy with credit in 2009 and 2010. So let's break the conversation into 2 pieces. What's the best case for using rules in making monetary policy?
Yeah, the best case for making rules is you're worried that if you give discretion to monetary policymakers, there's a number of factors that can influence their decision-making. They might be too short-term in their decision-making. There might be political economy factors that creep into their decision-making that will lead them to overshoot with respect to inflation on a systematic basis. And that is the argument that was advanced in the economics literature, academia, in the later part of the 70s by Finn Kidlin and Ed Prescott. They won the Nobel Prize for that, in part for that piece. And then John Taylor, who is a professor at Stanford University, wrote a very important paper arguing that central banks were in fact following a very simple rule. And so those 2 pieces together have come to solidify a consensus saying that one way to get low inflation outcomes is to have central banks follow rules. So that's the best case, I would think.
Right, and of course it's spread beyond the economics profession. There are even proposals in Congress to write into law that the Fed should have to have a rule and defend it. But in this paper, you argue essentially that's a mistake, and you'd rather trust the judgment of the men and women who are on the Federal Open Market Committee. Why do you think that's the better way to go?
Yeah, so there's 2 reasons for that. So the downside of rules is, I think, fairly clear. If you tie a group of people to a relatively inflexible approach, things can come up that they can see and observe and would like to be able to react to, but you haven't put into the rule. And that is, I think, the tension with taking away discretion, with forcing central bankers to follow rules. Now, you might be concerned that the Fed has, if you give them discretion, they're going to have too much inflation. You'll get too much inflation. But there's just no evidence of that in the last 20 years. Obviously, if you go back to the 70s, there's evidence that the Fed generated too much inflation. But there have been very systematic changes in the way the Fed operates institutionally, the way it interacts with the White House, that I think that those institutional changes are what protects us from inflation, and not putting a rule in would just lead to, I think.
But people in the markets who like rules argue that it makes the Fed more predictable. It's easier for people outside the Fed to know if the numbers go one way, what the Fed's going to do. You don't think that there's much point to that?
No, I think that the Fed's basic outcome should be to deliver on its macroeconomic goals of promoting price stability and promoting maximum employment. Putting in rules in terms of interest rates, while it might be convenient for some bond traders, are just going to get in the way of being able to hit those macroeconomic goals.
Okay, so let's turn to the time when you were at the Fed. You come to this with a rather interesting perspective. In 2009 and 2010, you were among the policymakers arguing that the Fed should be tighter with credit. And in this paper, it's essentially looks to me like you're trying to explain why you changed your mind and how you were misled by the adherence to rules. Is that fair or not?
That's a little too Kocherlakota specific for my taste. It is true, though, and it should be said that I was on the committee in 2009, 2010, and I was certainly someone who was concerned that deviating too much from past behavior could lead to undue amounts of inflation. So that was certainly my perspective. My point in the paper, though, is to say that this was not just my own perspective by any means, but was very broadly held throughout the committee. That there was that the the mode of behavior that the committee had used pre-2007, which I'll summarize as saying, following the rule, that John Taylor originally estimated, the Taylor rule, that there was a desire to stick pretty close to that. And that desire to stick close to pre-2007 rules led the committee to favor a very slow recovery in both the respect of both inflation and unemployment.
So the Taylor rule, of course, is one that tells a guide to what interest rates should be based on what the inflation rate is, based on how far we are from full employment. One of the points you make in the paper is the members of the Federal Open Market Committee had projections for what inflation and unemployment would be, and they said even 3 years out that they would be below their targets. And so is your point that they knew that they were following a policy that was too tight to achieve their targets, but they were kind of intellectually trapped by this Taylor rule framework?
I think that's a great way to summarize what I'm trying to say, is that the Taylor rule tells you that the right way to behave in a situation like 2009 and 2010 is to return the economy slowly to max employment and to 2% inflation. And it's because the Taylor rule incorporates a penalty for moving interest rates too far away from their long-run level. And so you want to get back to normal with interest rates relatively rapidly, according to the Taylor rule. Well, that's actually working against your the getting back to target with respect to your macroeconomic variables quickly, with respect to inflation and unemployment. So that being as you say, trapped in that Taylor rule framework led the committee almost automatically into thinking about a very slow return to full employment.
But in that period of time, interest rates were already at zero. Yes. The Taylor rule gives us a guide to what interest rates should be. They don't give you much of a guide of whether you should buy $600 billion or $900 billion or $1.3 trillion in bonds and quantitative easing. So was the Taylor rule, a formula for setting interest rates, really what was behind the decision not to be more aggressive on quantitative easing and on the forward guidance that you suggest?
So I think on the asset purchases, you're absolutely right. There's not much guidance in the Taylor rule asset purchases, although if you look at some of the remarks I made in 2011 and actually some of the discussion of the committee around the asset purchase program, there's an attempt to couch it in terms of the Taylor rule, so which I think is instructive. But really more, I think it's about how does the Taylor rule guide the removal of accommodation, guide the increases in interest rates that are to come. And a more aggressive form of forward guidance, which actually staff explored in some of the work they did for the committee in 2009, 2010, would have led the public to realize that actually the FOMC is going to be keeping interest rates low for a very long time. And that would have been very stimulative.
I see. And from the viewpoint of 2016, do you think that you're writing only about a period of history, or do you think that this conservatism continues to influence the FOMC in a way that you think?
A very good question, because I fear that we see a similar conservatism in Chair Yellen's speech that she gave at Jackson Hole a couple of weeks ago, where she outlined what the Fed's likely response would be to a recession. And you again see the very slow return to max employment taking 4 years after the initial shock. And actually in the forecast horizon, which is a decade, you do not see inflation return to target in her pictures. So there she's using as a basis of her analysis a slightly more aggressive version of Taylor's original rule, but it's still very slow relative to what the Fed should be doing in terms of achieving its goals as rapidly as possible.
Very good. Thanks for coming in today.
Yeah.